Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, Shiraz Mian here, joining Benjamin Brains. Ben and I each have a stock pick to share with you guys, so I'll go first. The stock I've picked is well known, and you may be wondering, why do you need me to explain to you that this is a leading stock? But after you give me a couple of minutes to hear my spiel, you will know what I'm talking about. The stock is Alphabet, Google. So I have a few slides where I'm using them to help explain my narrative about Google. This one shows the year-to-date performance for the stock relative to the tech sector as well as the S&P 500. The SP5, the green line here, is the ZAX proxy for the market index. And as you could see, the markets rebound from mid-April. Google has had a pretty decent participation in that. We saw that with the tech sector, the red line, and the green line for the S&P. But still, Alphabet is a laggard. Another interesting thing in this performance comparison is that since the beginning of the year, Alphabet has been a laggard. In fact, if you do this on a trailing 12-month, not a whole lot difference. So I jotted down the key points of why that's the case. And I don't have to go over each one of them, but it's instructive to keep this broader narrative surrounding the stock in mind as you contemplate whether it's a good buy or not. So there is the AI race, and there is this perception that perhaps others in the Mag 7 and in the broader AI race have overtaken Alphabet. I strongly disagree with that narrative, but even if Alphabet was the number second or the number third, I do not believe that the artificial intelligence world will be a one-winner marketplace. There'll be multiple winners at the end of it. It's hard to imagine Alphabet will not be one of those top 3-5 winners that would emerge at the end. By all means, there's a good chance that it could be all the way at the top of the heap when all is said and done. This is the second point I hear about the search threat. The threat to the company's search dominance is a second derivative of the first one, but also broadly related to what happens to the search piece of Alphabet's business once we have the universe, the AI world fully unfold in front of us. As we all know, search has been at the core of Alphabet's dominance. Search drives its digital ad monopoly, and any threat to this core business is problematic for the company. I think there is some nugget of truth to this. I suspect they may have to share the search world with others, but I can't imagine they will still not be the big kahuna in the search world at the end of this process. And I can give you all kinds of reasons for that, but they have such a huge lead in the space ahead of anyone else that it's, at a minimum, a reasonable assumption at this stage that they will be there at the end of the day as a major search player. There is the regulatory overhang tied to all of its different businesses. Hard to make sense of that. The U.S. backdrop, obviously, in the Trump administration is a lot more, I should say, less stringent than was the case in the past, but it's not. The regulatory overhang question isn't just the U.S. question. There's Europe, there's other parts of the world. The worries over the heavy CapEx spending, not solely an Alphabet issue, you would recall that pretty much all of the Meg 7 players are heavily spending outside of Apple, of course. And the market has been nervous, to say the least. The macro slowdown, that's a function of the company's cyclical exposure through its ad business. We touched on that earlier. Here, the context is that if the economy slows down because of tariffs, then digital ad spending will be a threat. A reasonable point, though I should note that the market is a lot less worried about macro softness today than it was 6 to 8 weeks. So cheap or a value trap, firmly in the cheap category here. And that's the crux of my narrative with you guys. Here is forward 12-month PE over the last 10 years for Alphabet. As you can see here, it has traded as high as 31.6 times. The median has been 44.4 and currently trading at 16.89. So definitely a pretty enticing value prop here. Here I'm comparing Alphabet and the S&P 500 index. And as you could see here, the stock has pretty much always traded at a premium. This is about late 2021, early 2022. Up till here, in this time span, the stock has always traded at a premium. Then over the subsequent 2 years, it kind of tracked the market. And then lately, it has been trading at a discount. So as you could see here, the S&P 500 represented by the red line, 21.7. And as we noted earlier, Alphabet is under 17 times. This is the same chart as the preceding one, Google, Alphabet versus the S&P. But here I'm representing the Alphabet multiple as a percentage of the market multiple. So what this shows is that the S&P 500, the premium to the Alphabet multiple. So Alphabet is currently trading at 78%, 0.78 times. So 78% of the market multiple. Over the preceding 10-year period, it has traded as high as a 78% premium, as low as 0.76. So that's a 24% discount. And today at 0.78, which is a 22% discount. So it has practically never traded as low as where it's trading right now. This is the earnings estimate revisions and the company's growth outlook. So these squiggly lines, the different color squiggly lines represent how estimates for the individual years have evolved. This light blue, that is 2025. Okay. Which one is 2026? Okay, the red one. So you could see pretty stable earnings outlook, and the gap between the two lines, you could visually see that as a proxy for the year-over-year growth rate. So a very strong growth profile, attractive valuation. One additional point that I did not emphasize is the individual businesses. Obviously, everybody's very well aware of the individual businesses. We touched on the search, but there is the streaming business through YouTube. There is the EV business. And my sense is that between these three plus the other bets, the market's fixation has been on the search and the AI at a complete discount for the EV and the streaming businesses. So I see Alphabet as a true value pick at this stage. Obviously, it's not a tactical trading advice, but rather a long-term investing advice. If you don't own the stock already, I'll strongly recommend that you start building a good core long-term position in Alphabet in your portfolio. I strongly believe you'll be happier at the end of the day. With that, I'll pass it on to Ben, who has an amazing techie type of pick of his own.
Thanks, Shiraz. Hello, everybody. Ben Rains here for my top stock pick of the week at Zacks. Today, I'm looking at Intuit, which trades in the ticker INTU. Intuit stock soared to all-time highs after the TurboTax owner posted a big beat and raise third quarter in late May, boosted by expanding artificial intelligence offerings. The tech giant finally broke out of a trading range it's been stuck in since late 2021. Wall Street's increasingly convinced that Intuit's expanding portfolio and AI enhancements will help keep it churning out double-digit sales and earnings growth going forward. Intuit stock has also crushed the tech sector in software standouts such as Microsoft over the last 20 years. So this breakout could be a good time for investors to get back into INTU stock. So it has been one of the biggest players in a quarter of the economy that's never going out of style because there's only really two certainties in life, as everyone knows, death and taxes. The company's ability to consistently improve and expand TurboTax software has transformed the stock into a tech powerhouse. Its essential and timeless software offerings help it post consistent top-line expansion that's impressive even among its mega-cap tech peers like Microsoft and Alphabet. It averaged 16% revenue growth over the last decade, alongside 15% average GAAP earnings expansion. Intuit expanded its software portfolio far beyond TurboTax. It's now become a one-stop shop for businesses and consumer finance, email marketing, and digital ad services and beyond. So it has Credit Karma, QuickBooks, and MailChimp all in one. It boasts roughly 100 million customers across its various businesses. And most importantly, in the last year or so, it's rolled out new AI efforts to take on any new age challengers in the artificial intelligence world. So it's reshaping its tax-assisted preparation market by leveraging its AI-driven expert platform to have scalable, kind of cost-effective alternative. So most recently, it posted a big beat and raise third quarter for fiscal 2025 in late May. Its AI-powered innovations and personalized offerings spurred growth across the portfolio. Specifically, its AI-boosted TurboTax Live, which is an assisted tax preparation service that combines human experts and automation, saw its revenue skyrocket 47% to $2 billion, representing 40% total consumer group revenue. So now let's go over to Zacks.com to check out our estimates for Intuit and some more charts as well. All right, before we head over to Zacks.com to check out Intuit, just quickly go on their website just to give a sense of these are their four main offerings. As I said, TurboTax is kind of that forward-facing consumer one that everyone knows, but they also have Credit Karma, QuickBooks, and MailChimp. So if you ever want to peruse the site, it's good background for all the various things they offer. But overall, we're going to take over and go to Zacks.com, check it out. It's a Zacks ranked number one strong buy stock now. You can also see that it's computer software industries in the top 18% of 245 Zacks industries. So that's always a great sign. And now we're going to go to take a look at our earnings outlook. So we're calling for 15% revenue growth. So double-digit revenue growth again this year to extend its streak past a decade, get up to about $18.74 billion, and then do another 12% growth next year on the top line to get up to nearly $21 billion in terms of full year sales. And on the bottom line, we're calling for an impressive 18.5% adjusted earnings growth and then 14% growth next year. And we can see that since that big report, actually better go over here, take a look at the snapshot. So since its release in late May, both of its, so this is 2025 and 2026, both of its estimates are up 4%. And we can see that that's helped kind of turn around since its estimates had kind of gone sideways for the last year or so, kind of as the stock chopped along. Those positive revisions that we've seen here have helped the stock jump straight up. So we'll go and take a look at these interactive charts right here on Zacks.com. We'll go to show it in a line. We can see, we'll blast this out to 5 years. We can see that it kind of chopped around throughout 2024, trying to get back above those 2021 peaks. And finally, in late May, after that report, it soared to new all-time highs. And if we jump here, we can see the stock is just ripped higher. And this is starting when they offered, this is when kind of the software as a service and everything just really took off. So it's been on an amazing run. And we can see that it chopped out here way above even where it was back in November. So a good sign there as well. And this is our analyst reports on Zacks.com. So we can see that this is their longer term estimates for earnings and revenue, just going straight up, which is a great sign. And then this is our longer term outlook for earnings over the next several years. So we can see that the stock has, as I said, broken out, and it makes sense because their earnings are trending heavily in the right direction. And then I also want to go take a look at this tab here. We can see that Wall Street's still really high on the stock. So we have 29 brokerage recommendations and 23 are coming in as strong buys, 2 more buys, 3 holds, and only 1 strong sell. So Wall Street's still really high on Intuit stock, and for a very good reason. In the end, traders and long-term investors might want to wait for possibly a small pullback to buy Intuit stock, but market timing can be really difficult, and there's no telling when Intuit might fade, since the strong stocks that break out of a prolonged holding pattern tend to surge longer than many might assume. So overall, though, if you're a longer-term investor, putting Intuit on your radar seems like a good play at the moment. And that does it for me in this episode of Top Stock Picks. Please head over to Zacks.com/promo page to look into some of our services, portfolios, and more.